There is a piece of financial advice that every wealthy family quietly passes down to their children. And it directly contradicts almost everything the financial media, the investment apps, and the self-help books have been telling the rest of us for decades. Old money does not invest the way you've been told to invest. Not even close. I've spent years studying how generational wealth actually behaves. Not what wealthy people say in interviews, not what their public-facing financial advisors present at conferences, but what these families actually do with their money, quietly, consistently, and across generations. What I found rewired the way I think about money completely. Today, I'm sharing all of it. 10 investment principles that old money lives by, and that almost nobody outside of those families ever talks about. Stay until principle number 7. That one specifically is the one nobody expects. Before we get into the 10 principles, I need to establish something that changes the entire context of this conversation. Most financial content, the YouTube videos, the podcasts, the personal finance bestsellers, is written for and by people who are in the process of building wealth from zero. That's a legitimate and important goal, but old money is not in that process. They solved that problem generations ago. What they are managing now is something fundamentally different. They are managing the preservation, the growth, and the eventual transfer of wealth across time, across market cycles, across political regimes, across 3 and 4 and sometimes 5 generations of heirs. When your investment horizon is measured in generations rather than years, your entire relationship with risk, return, liquidity, and patience changes completely. And that is exactly why their investment philosophy looks so foreign and so counterintuitive to anyone operating with a different time frame. These 10 principles are not 10 tips. They are a complete alternative philosophy. And once you understand the logic underneath each one, you won't be able to unsee it. 1. Preservation first, always. The very first thing that separates old money investing from almost every other investment philosophy is the order of priorities. The conventional investing framework goes like this: grow your money, diversify it, preserve what you can. Growth is the primary objective. Preservation is what you do later, when you're older, when you have enough. Old money reverses this entirely. Preservation is the primary objective. Growth is what happens inside a preservation framework. This sounds conservative. It isn't, it's generational. When you are managing wealth that must survive for 100 years, the most catastrophic possible outcome is not underperformance. It is permanent capital loss. One devastating, irreversible loss can undo 3 generations of patient compounding. So, the first question old money asks before any investment is never, what's the upside? It's always, what's the worst case, and can we survive it? The practical consequence of this philosophy: old money is dramatically more risk-averse than their net worth would suggest. They say no to far more opportunities than they say yes to. They miss bull markets. They miss lottery ticket investments. They do not care. What they don't do is catastrophically lose. And over 100 years, not catastrophically losing beats aggressive growth almost every time. 2. They hold far more cash than they admit. This is the one that the financial media will never tell you, because it undermines the entire machine that makes the financial media profitable. Old money holds cash, significant cash, not as a failure of investment strategy, as a deliberate, intentional weapon. Here is the logic. In every asset class, stocks, real estate, private businesses, art, land, There are moments of irrational pricing, moments when a great asset becomes available at a fraction of its real long-term value. Market crashes, forced sales, divorces, estate liquidations, business failures. These moments are rare and they are unpredictable, but they are recurring. Old money positions itself to be a buyer in those moments. Every time. That requires one thing above all else: liquidity. Available capital that isn't trapped in an illiquid position, riding out a downturn, or locked in a redemption period. The wealthy tell the public to be fully invested, always. Meanwhile, their family offices maintain cash reserves and liquid positions that most financial advisors would consider irresponsible. Not because they don't understand compound interest, because they understand opportunity. And they've learned that opportunity respects cash. While the rest of the market is panicking and selling, old money is quietly, patiently buying. 3. They only invest in what they deeply understand. Warren Buffett calls it the circle of competence. Old money families had a version of this principle long before Buffett gave it a name. They do not chase sectors. They do not follow trends. They do not allocate capital to something because a respected advisor recommended it, because the returns last quarter were impressive, or because everyone at dinner is talking about it. They invest in what they understand, deeply, personally, and often intimately. A family with 3 generations in agricultural land understands that asset class in a way no financial model can replicate. They understand the soil, the cycles, the regulations, the tenant relationships, the geopolitical variables that affect commodity prices. They have an information edge that is nearly impossible to replicate from the outside. So they stay in their lane. They go deeper, not broader, and they extend into adjacent areas only when they have built real understanding, not theoretical knowledge, real understanding. The investor who deeply understands one asset class and compounds inside it for 40 years almost always outperforms the investor who is perpetually diversified across things they don't fully understand. Old money has proven this across generations. The lesson: know your lane. Own it completely. Be suspicious of every opportunity that lives outside it. I want to pause here for a second because we're about to get into the 5 principles that most people genuinely never consider. And they are, in my view, the ones that separate old money from every other investment philosophy. The first 5 are things smart investors understand. The next 5 are things that only become obvious after you've watched wealth survive for generations. Keep going. 4. Time is the asset. Everything else is a vehicle. Most investors think about time as something they manage around their investments. Old money thinks about time as the investment itself, and everything else as merely the vehicle through which time does its work. Compound interest is not a strategy. It's a force of nature. And like all forces of nature, it rewards patience with a disproportionality that short-term thinking never captures. A portfolio growing at 7% annually doubles in roughly 10 years, doubles again in the next 10, and again in the 10 after that. Over 40 years, a single invested dollar becomes $16 without adding a cent. Old money doesn't need to add a cent. The principle is already there. So the entire focus becomes one thing: don't interrupt the compounding. Don't panic sell. Don't redeploy into something speculative. Don't touch the engine while it's running. This is why old money investors appear, from the outside, to be almost passively indifferent to their portfolios. They're not. They are intensely active in their conviction that the worst thing they can do is react, that watching closely is different from interfering, and that the single greatest return they can generate is leaving patient capital alone long enough for time to do the work that no strategy can do faster. 5. They use debt as a tool, never as a lifestyle. Old money's relationship with debt is one of the most misunderstood aspects of their financial life, because from the outside, it can look like they simply avoid it. They don't. They weaponize it. The distinction they make is absolute and non-negotiable. Debt used to acquire an asset that generates income, appreciates in value, or creates leverage in a productive enterprise. Acceptable and often actively sought. Debt used to fund consumption, lifestyle, or appearances, never. Under any circumstances, for any reason. This means old money will take on significant debt to acquire a property that generates rental income and appreciates over decades. They will leverage a business acquisition. They will use credit facilities to maintain liquidity while their capital is deployed elsewhere. These are all productive uses of debt, where the cost of borrowing is lower than the return on the asset it finances. What they will never do is borrow to fund the appearance of wealth they haven't built yet. No lifestyle debt, no debt that funds depreciating assets, no debt that exists simply because the monthly payment is manageable. The rule is simple and clean. Debt is a tool that multiplies whatever it touches. Make sure what it's touching is an asset, not an ego. Quick pause. If this video is landing differently than the usual investing content you watch, that's because it's coming from a different philosophy entirely. Subscribe if you want more of this. We go into the old money mindset, lifestyle, and financial philosophy every week. 5 more principles to go, and these last 5 are the ones the financial industry genuinely doesn't want discussed. Let's keep going. 6. They invest in private markets, not just public ones. Here is something that virtually no mainstream financial content covers, because mainstream financial content is funded by the public markets infrastructure and has very little to gain from discussing alternatives. Old money does not live primarily in the stock market. Yes, they hold equities, but a significant and often dominant portion of their wealth is deployed in private markets, private equity, direct real estate ownership, private credit, family-owned businesses, farmland, timber, mineral rights, and private lending. The reason is not exclusivity for its own sake. It's structural. Private markets offer something public markets cannot: illiquidity premium. Because you cannot sell a private asset at the click of a button, you are compensated for that illiquidity with higher long-term returns. You are also protected from yourself. You cannot panic sell at the worst possible moment because the exit process takes months or years. Private markets also offer information advantages that are structurally impossible in public markets. When you own a private business or a private piece of real estate directly, you have access to information that no public shareholder will ever see. Old money has been exploiting this information edge for generations. The practical application for anyone not yet at this level: the mindset is accessible before the asset class is. Start thinking like a private market investor. Evaluate everything on its long-term fundamentals, not its daily price. And as your capital grows, explore the private alternatives that public market investing crowds out. 7. They have a financial board of directors. This is the principle that nobody expects, and the one that, once you understand it, reframes almost everything else on this list. Old money does not have a financial advisor. They have a financial board of directors. At minimum, this board consists of 4 people: a private wealth manager who oversees portfolio strategy, a tax attorney who structures every investment for maximum fiscal efficiency, an estate planning specialist who ensures the wealth transfers correctly across generations, and a trusted accountant who coordinates all 3. These 4 people meet together, they work together, they know each other's work, and they challenge each other. The private wealth manager strategy is immediately stress-tested against the tax attorney's knowledge of the consequences. The estate plan is always current, not a document signed 15 years ago that no longer reflects the family's reality. What this costs is significant. What it saves in tax exposure alone is almost always a multiple of the cost. Old money treats professional advisory fees the way they treat quality purchases in every other area of life. The cost per outcome of excellent advice is dramatically lower than the cost per outcome of poor advice, regardless of what the headline fees look like. The mindset to build right now. Stop thinking of financial professionals as individual service providers and start thinking of them as a coordinated team. Even at modest wealth levels, having a tax-aware accountant coordinate with a financial advisor changes outcomes meaningfully. 3 more. And the last one, Principle 10, is the one that ties everything together. It's not about an asset class. It's not about a strategy. It's about a single philosophical commitment that makes every other principle on this list possible. Don't skip it. 8. They diversify across generations, not just asset classes. The conventional wisdom on diversification goes like this. Spread your investments across asset classes, stocks, bonds, real estate, commodities, so that when one falls, others hold. Old money does this, but they add a dimension that almost no financial textbook discusses: temporal diversification. Diversification across time, across generations. This means structuring the portfolio so that different portions of the wealth are operating on different time horizons simultaneously. Some assets are liquid and accessible for current generation needs. Some are medium-term, real estate, private equity, with a 10 to 20-year horizon. Some are long-term, family businesses, land, timber, with a generational horizon measured in decades. No single economic event, no single market cycle, and no single generation's bad decisions can touch all 3 layers simultaneously. If the short-term layer is hit by a recession, the medium and long-term layers are untouched and continuing to compound. If a single generation makes poor decisions with their allocated capital, the foundational layer, held in trusts, in structures, in assets with legal protections, is preserved for the generation that follows. The wealth is not one portfolio. It is a living, layered system designed to survive time itself. 9. Philanthropy is a financial strategy, not an afterthought. This one is genuinely counterintuitive, and it's one that old money understands with a precision that most people who give charitably never develop. Philanthropy, in the old money world, is not something that happens after the financial strategy is complete. It is part of the financial strategy, structurally, legally, and generationally. Charitable foundations and donor-advised funds offer significant tax advantages that reduce the effective tax rate on investment gains, income, and estate transfers. Assets donated to a properly structured foundation remove those assets from taxable estate calculations. The family retains influence over how the funds are deployed, and the family name becomes permanently associated with generational contribution. which, as we've discussed in earlier videos on this channel, opens doors that money alone cannot open. This is not cynical. The outcomes, genuine charitable impact, and intelligent tax strategy are not mutually exclusive. Old money has simply figured out how to do both simultaneously, rather than treating them as separate categories. The broader principle: in the old money world, there are almost no purely financial decisions, and almost no purely personal decisions. Everything is connected, everything is structured, everything is considered across its full range of consequences: financial, reputational, generational. 10. They never discuss their portfolio, and that is itself the strategy. We've reached the last principle, and it is the one that makes all 9 of the others possible. Old money does not talk about their investments, not at dinner, not at parties, not in interviews, not on social media. The portfolio, its size, its structure, its strategy, its performance, is private. Completely, non-negotiably, always. This is not just social etiquette, though it is that too. It is a sophisticated form of information management with direct financial consequences. When you do not disclose your investment positions, you cannot be manipulated out of them. You cannot be talked out of a long-term holding by someone with short-term thinking. You cannot be pressured into a trend by social proof. You cannot be targeted by people whose interests are misaligned with yours. You cannot be talked into a bad deal by someone who knows what you're holding and what you might want. Financial silence is financial protection. It creates the conditions under which patient, long-term private investing can actually function. Without the constant noise, pressure, and social comparison that destroys most individual investors' decision-making. The market is, at its core, an information game. Old money's most powerful informational strategy is not what they know. It's what they don't reveal. The family that says nothing about its wealth is almost impossible to play against. And in a game that runs across generations, being unplayable is worth more than any single investment principle on this list. 10 principles, all of them quiet, none of them on the cover of a financial magazine, and every single one of them grounded in the same underlying logic. Old money invests for time, not for applause. Preservation before growth. Cash as a weapon. Deep understanding over broad diversification, time as the real asset, debt as a tool, never a lifestyle, private markets for the illiquidity premium, a coordinated advisory board, temporal diversification across generations, philanthropy as integrated strategy, and financial silence as the ultimate competitive advantage. Here is the thing I want you to take from this video. These principles don't require a trust fund to adopt. They require a mindset shift from short-term to long-term, from reactive to patient, from public to private, from loud to quiet. That shift is available to anyone, right now, regardless of your current balance. Old money wasn't built in a generation. Neither is the philosophy that sustains it. But it does start somewhere, and it starts with exactly the kind of conversation we just had. One question for the comments: which of these 10 principles is furthest from how you currently think about investing? I want to know, and I read every single response. Subscribe if you're not already. This is the conversation we have on this channel every week. I'll see you in the next one.